Hi, this is Stephanie Johnston over at the Johnston team at Service First Mortgage. I wanted to go through with you guys today understanding cash to close and some information regarding that. So this example is going to go through a conventional 30-year fixed and an FHA 30-year fixed for a $300,000 property. Note that the cash to close principles are going to be the same on any loan amount. So this information will apply to any different price point and any different loan. I just use that for an example. So the cash to close on this first one in conventional, this front page is going to give us some information of a summary. So this is in your mortgage portal that we sent out underneath closing cost tab. And this is something that we do go through and work up individually for each customer. And we'll go through that via phone or in our in-office appointment. But this gives you a little information in the meantime. First line here is going to have your down payment. So this was 5% down conventional, and this one over here is 3.5% down FHA. I'll show you why this number underneath there is a little bit different in a bit. Then on top of that, you're going to see APR fees, non-APR fees, prepaids, contributions. It's a lot of numbers, so I find it a little bit easier to do the next page or look at the fee detail to get to where these numbers come from, and then I'll come back to show you kind of how we got to these totals. So if you click on fee detail, there's going to be 3 buckets of cost. So if you remember the 3 buckets, it makes it a little bit easier to understand where all these crazy numbers are coming from. So the first one is going to be our lender fees. So I label those lender fee and put processing and underwriting behind those to show you how much it's going to cost. On our examples, we usually are going to start people with no origination, no discount points, and what we call a par rate. So there are other rate options available and other cost options available, but this is just demonstrating, a loan at 0 points / your origination, if that is helpful. So again, those 2 fees are all we have. So $595 and $595, $1190 for Service First for our part in the mortgage transaction. And again, there's options at higher and lower than that. This is just this example. Then the third-party costs are going to show you what everyone else is going to charge. So these are fees that aren't determined by us, but are going to be a pretty close estimate of what you should need. So this is an item such as an appraisal, so a determining value. Attorney fees, the title company and us need attorneys to draw our closing documents, so an estimate $275 for them. Recording for the county to show you own the property, about $150. We put a miscellaneous title fee in here in case there's an item that we don't know about or an extra charge. We just don't want to be short. We want to be on the high side of numbers. Come back to survey. The title company closing fee to close your loan and do all their paperwork. And then title insurance. Move this over here real quick. So your portion of title insurance is usually about $250 is the buyer's side. The seller's portion is going to be a percentage of the loan amount. So that's one in here, or the sales price, excuse me, about $2,100 in this example. So that's something, as you see marked in there, that's paid for by the seller. Why we illustrate this is if you're doing something like a new build where it might be common for the buyer to pay title insurance, or there's multiple offers and the seller is going to require the buyer pay for that, this would get moved to your side. But again, it's an item in here and not included in your cash to close. As you see at the bottom, it shows seller paid, so not included in the total cash. So if I add up all of these third-party fees, not including the survey, that's going to equal about $1,600. So all of that in here. The last item is the survey. And why I put this on its own little island is sometimes we can use the seller's existing survey. So when you close a property in Texas, a lot of times the sellers have an existing survey, and that's something that if the title company accepts it, we could use the existing and save everyone $400. And on the Texas contract, sometimes it's buyer paid and sometimes it's seller paid. Just depends on your negotiating. So if we go back to the high level numbers, $1,190, $1,600 for third party, and then $400 if you need a survey. So that's going to equate to about $2,800 in closing cost without a survey, or $3,200 in closing cost with a survey. And those numbers should hold very true whether the house is $100,000 or $400,000, as those numbers are not percentages of, they are flat figures. So again, 3,000-ish should be a good figure to use when estimating approximate cash to close really on any home for closing costs. Now the last bucket is the part that I think is a little more shocking, especially to someone that's not purchased a home before, and that's our prepaids. So the prepaids are the ones that are marked yes over here on the side, and those are funds that we need for taxes and insurance at the time of closing. So your hazard insurance premium is your home insurance, just regular insurance. We just, on this end in mortgage land, they're called hazard insurance, but it's your regular insurance policy that you, the buyer, select and choose a company you'd like to use. This is also why we usually recommend immediately upon contract acceptance to please call an insurance company and get a quote for your home insurance. Insurance is very property specific, so we get as close as we can up front based on your search parameters, but it's something that you'll have to get, fine-tuned once you get that house under contract. So you're going to have 1 year of insurance that you pay to your insurance company at closing, and that's going to insure your house for the first 12 months of ownership. Insurance is required to be paid before use, so that's why that you need the full 12 months, and that goes straight to your insurance company. So that's not money that's going to be sitting with the mortgage company, goes to your insurance company up from the title at closing. Then you're going to see a number, and this is if you do escrow for your tax insurance. This is representative of 3 months of home insurance and 3 months of property taxes. And why we have the 3 and the 3 are there's going to be about a 30 to 60-day period in which you do not make a mortgage payment after you close. And we want you to have a little bit of a cushion in that account in case your taxes and insurance change in the future. So although these numbers will be different in your specific scenario, the actual how many months will be the same. So again, a year here, so 12 months. 3 months is usually the high side, so it's usually 3 or under-ish, which is why we use the 3. And then 3 months again for your property taxes. So if we look at this example, it's a little over, a little about $4,000 for prepaid. So it's actually more for taxes and insurance than closing costs. So it's not a sunk cost, but just money that you need up front to set up your taxes and insurance. Now, the last number down here, there's a number that says prepaid interest of $483 at the very bottom here, if y'all see that. What that's going to represent is 15 days of interest. So whatever day of the month that you close, you're going to have the remainder of the days collected at closing. So we just use 15 to be in the middle. So this would be just the remaining days, and that adds to the total. And so when we add the prepaids, the property taxes, closing costs, everything all together, that's how in this example we get up to about the $7,500, figure. So if we come back and we see it in this manner as well. The APR and the non-APR fees, so those are your total closing costs. Then we come up here and we're going to see the prepaid for your tax and insurance. And we're going to show that the seller paid that seller policy, so that's why that's shown there, getting you to the $22,500 in this example. So that's where we get there. Now, the only thing different on the FHA loan I just want to show you, if you do a loan that requires upfront mortgage insurance premium, meaning if you're doing an FHA loan, a VA, or a USDA loan, you'll see a number over here, a bunch of abbreviations. So that's UFMIP, so upfront mortgage insurance premium or funding fee is FF. And that's if you do have a loan that charges an upfront item. That's actually rolled in your loan, but you'll see that listed right here to show you how much that's going to cost if you were comparing loan options. And this will be 0 if your option's if you're doing a conventional loan. So that's really the only difference. The cash to close on the actual closing costs are different, and then that number is over here at the side as well. So again, I hope this provides some clarity in understanding cash to close. And if you think of it again, the buckets, so your closing costs and then your prepaids, usually helps show where all the cash to close is coming from. And of course, we'll go through this exact scenario or your exact scenario with you, and any questions that you have on that. And hope this information was helpful. Again, it's Stephanie Johnston over at the Johnston team of Service First Mortgage. And on the screen, we'll have all my contact information if you have any questions. Thanks.